No, it's not economy, it's markets this time. Despite the Fed's uber-hawkish forecast, India's mid-cap rally, just notice, is continuing today. It's only the large ones who are reacting. And that's going to be, the mid-caps are going to be the meat of my chat today with veteran market watcher, Sridhar Sivaram, Director, Enam Holdings. Sridhar, just let me read out a few facts before I come to you. In terms of mid-cap performance. In 2023, mid-caps and small-cap index have rallied 28%, while the Nifty has rallied only 9.9% to date. Within mid-caps, PSU index has rallied 35%. Standout gainers are PSU railway stocks, RVNL and IRFC gaining 138 to 140% each. Power PSUs, SJVN, of course, the government is taking advantage of it, and transformers and rectifiers gaining 120 to 200% each. And PSU Banks, Bank of Maharashtra, Central Bank, IOB, UCO and Indian gaining 47 to 55% each year to date. Now, Sridhar called out the PSU Bank rally almost a year ago, and that's the reason why I have invited him. But Sridhar, just to keep with the theme of the morning.
Sure.
First, thank you for coming to the studio.
No, thanks for inviting me.
This Fed statement, I mean, what stood out for me is they've doubled the GDP forecast from 1% to 2.1%. So really, is this just an immediate reaction and we are actually in for some safety for the equities world over?
Yeah, so I think there's good and bad news. So the good news, of course, is that there's no recession or a hard landing. Maybe there is a recession at some point, but it's a soft landing being managed. And the bad news is that that inflation is stickier and higher for longer. And so I'm not sure how Fed can manage this in terms of bringing the rates down. I think it's some time away, at least. Maybe there is another rate hike.
By their own forecast.
Yeah, maybe there's another rate hike. Who knows? And, you know, crude is already where it is beyond 95. And US has a larger impact on commodities than the Indian inflation because CPI in India has a much lower weightage on some of these. So I think we have to brace for higher inflation and longer higher rates for a much longer period. And that's how I would look at it. Okay. Good news, of course, is that the economy is doing well. So the markets will have to, somehow brace both of the good and the bad news and see how it goes.
A terrible cataclysmic fall doesn't seem going by the way they've both. Even actually unemployment is revised lower than earlier. Okay, so now let me come to the big thing for which I called you. A year ago, I heard you say on Sonia's show that you would...
so Latha, sorry to stop you. It was February 21, so it's 2.5 years back.
Shucks.
And we started investing sometime in November of 20. So that's when we started.
Sridhar, you're a rich guy. Sridhar, you're a rich man. Okay, let me come to the meat of the story. PSU Banks. I mean, everything has run in the first place. You've got Central Bank, UCO, all of them rising day after day, 20%. Plus Bank of Maharashtra, a stock that you had spoken about earlier. So do you still go for some of these stocks? I'm now referring to the mid-small PSU banks. I'll come to the larger ones.
So Latha, the way we look at it is that one, the mistake the markets and many of us have made is to look at PSU banks as a homogeneous entity and say, okay, I buy PSU banks at half book and sell them at one book. But what has happened is as we've gone and we've analyzed some of these banks in a lot of detail, you have banks with ROA of almost 2% to banks which have ROA of 0.5%. How can you give the same multiple for a PSU bank which has such varied, return on asset? Generally, you say 1% ROA is great. If a bank is generating almost close to 2% ROA, I mean, it's almost close to a private sector efficiency bank, then what sort of multiple will you give? I'm not here to judge what should be the right multiple, but this is how we are seeing it. So to say that, you mentioned a few names, I'm not going to get into specifics. Within that, some of them are really efficient. I mean, I want to refer to a private sector CFO who mentioned recently that, listen, we are struggling to, get a 30% CASA and look at this PSU bank, it has 53% CASA. So I'm really envying and I'm wondering what they're doing right. So this is the private sector talking about a PSU bank. I think things have really changed over the last 3-4 years where I don't think the deposit market share is falling anymore. That's how I would put it. I think there's still a lot of room, but you have to be very selective. Some of them are have moved without much of fundamentals, but some I would argue have a lot more steam to go.
Okay, I know you can't talk stocks, but if I'm not mistaken, it is Bank of Maharashtra which has got over 50% CASA. You're not saying it. I think that's what Google is telling me. Okay, let me come to the. Therefore, you would take ROA as an important consideration while investing.
So Latha, when you're looking at banks, you look at ROA, you look at ROE, price to book, and I have started looking at the deposits, the liability franchise very closely, because we know that we are into a great credit cycle, and this will end at some point of time. So I'm happier with banks which have a lower cost of funds, because if my cost of funds are lower, I don't need to take that much risk to generate my returns. So we are looking at various parameters, so I cannot say that one is more important than the other. Coverage ratio is the other one which we would look at. So I think there's a multiple factors, but in our filters we still find at least 4 or 5 PSU banks which still may have room to go.
51% from what I last gather, maybe my data is a little backdated for Bank of Maharashtra, and even Central Bank actually fairly decent. I think it's 49% for Central Bank. But would you not worry about other things? Like margins are crunching for everybody. Reserve Bank has kept liquidity tight. Now the repo is closer to 6.75, 6.8. So margins are over, and even the credit cost story, fallen. But is there more room to go in many banks?
So I would say that barring 2 banks, which is I think SBI and BOB, where the credit cost has fallen below 100 basis points, SBI is almost 50 basis points. I think there's still room for a lot of the others. We're still in the 1 to 1.5% range, and back in February 2001, when I had come and told the story, at that time the credit cost for most of the banks were 2.5, and our view was that credit cost will fall to 1.5. Obviously, we are changing our view now, because we never anticipated that the environment will become so benign that even a bank like SBI is having only 50 basis points of credit cost. So we are having to relook at it. And our general view on PSU banks have always been that this is not a structural story. It's a cyclical story. We are playing that cyclical story. But as we've played, the environment has improved. So in normal circumstances, maybe in 2 years, we would have moved on to something else. In this case, it's been almost 3 years, and we are still seeing a lot of opportunity in staying on with this story, because the environment has changed. Having said that, we keep a very close watch on some of these, because as you know, if credit environment changes, a lot of this can change overnight.
Oh, absolutely. Well, to tell you, even the regulator becomes cleverer. They have something called that CRILC or CRIL-C, which they've created, where the moment they default, that week itself, on that Friday, banks have to report. So this accumulation, or banks playing one bank against the other, borrowers playing one bank against the other. The cycle may not repeat with the same ferocity that it did, but who is to say? Let me come to the private sector. Some of them old private sector, some of them even new. Those have also done extremely well. South Indian, I remember, did very well. Karnataka did very well. So are you also looking at the mid-cap, private sector banks?
So Latha, we do have some of the mid-cap private sector banks in our portfolio. And having said that, we do analyze the balance sheets very carefully. And in some of them, I'm finding, red signals. You'll remember that many years back, I had highlighted to you a Yes Bank red signal. The easiest thing for us is to, move out of, banks. We are not hedge funds to short. So we just move out of those stocks when we find red flags. We are currently finding some red flags in the smaller private sector banks. And when the RBI...
Red flags is in the nature of what?
In
unsecured
the
loans being big?
I don't want to get into too many details.
But what kind of red flags, if you can educate us on
that? Some of the expenses are very high. Obviously, the other thing is that the red flag also comes from the fact that the RBI governor has put out a statement. So I'm not saying this. The RBI governor is on record saying that banks are evergreening, and he's put out a host of ways that they're doing. When the governor puts out this, it's only fair on our part to relook at the balance sheet and see if some of them matches. In our view, in some cases it does. So we don't have really enough proof, and we're not very sure why the governor just stopped at making a statement like that and then did nothing. So the best thing for us is
they are doing it through supervision, maybe.
Maybe.
Not,
so as investors, we don't have more information. So we just, where we think there are red flags, we just move out of those stocks. But we don't have enough proof to justify what we are saying.
Okay, let me ask this because, I will be running short of time. How many PSU banks do you have in your portfolio?
We'll have 3 or 4.
Okay.
PSU banks.
So I'll try to deduct from that.
Yeah.
What about railways, power stocks? Okay, more than railways, it is power that's doing very well, and across the board, both private and. Are you playing that space?
So we earlier had played, now we are not there. But in general, I think I'll go back to say 3 years back. The entire PSU basket had just about a 10 lakh crore market cap, and I remember mentioning this number because we were watching this very closely. Just Reliance had more market cap than all the PSUs put together then. Today it's almost 25 lakh crores. I'm excluding LIC because LIC was not there in the calculation at that point of time. And I remember having recommended, for the investors that you just buy a PSU fund. And one of the, mutual funds from then to today in 2.5 years has doubled. So it's almost 30%, IRR. Return for the investor. Is there more juice left in the entire PSU basket? I think it is no longer as attractive as it was 3 years back. You have to look at it from a case to case. So even that is the case even with the power stocks. So you have to look at it from a case to case. If there is earnings growth, is this high valuation sustainable? So I'm not as gung-ho as I was, say, 1 year back or 2 years back on the entire PSU basket. Yes, specific PSU banks, I think there's still a lot of room. Like defense was a thing we played, but the stocks have rallied a lot. I mean, every time there's an order,
200%.
Yeah, these stocks go up. So at some point, you look at it and then say, okay, is the risk reward in my favor? Maybe it's not. It is left to individuals to decide if a fund wants to play that. We have taken a view where we should, book profits and move on.
Okay. Well, actually, defense I didn't put in that list, but you have seen BEML, BEL, all of them up between 35 and 60%. Okay. A final question: with caps generally,
yes.
I mean, there are some signs of froth which I would worry. I mean, there are a lot of mistakes being done in the options trades. As well, I think our derivatives volume is like 5 times US derivatives volume. So is there anything about the mid-cap rally of 28% that would alert you?
No, of course. It is a red signal because the index is up 28%, but there are pockets which are up 100%, and there isn't enough revenue or profits to justify some of these moves. Having said that, we do own a lot of mid-caps, and I think where there is earnings cushion, we are happier to hold. Sometimes what happens is that stocks we like move up much faster. We would expect a move of, say, 30-40% to happen over a year's time or 1.5 years. It happens in a month. But it's not. These are stocks which is not easy to buy and sell. So then you just hold on, knowing that there's possibly the correction, and you would, hold on and play the entire rally. So these sort of irrational exuberance happens where there is earning support. I would clearly hold. Where it is more froth and a theme or there isn't earning support, I think those individuals they should have a serious look at it. But today the retail investors are so gung-ho about mid-caps. Look at the mid-cap funds which are getting the subscription. I mean, they're going through the roof. Even the fund managers are struggling to buy stocks in their fund. So I think there are red signals here. But overall, I think we still remain constructive on stocks.
I may be fired for going out of time now, but one sentence on HDFC Bank. Is it now good enough to buy?
Latha, we will not. I don't want to comment on individual stocks, but we generally are bullish on the large cap private sector bank, and especially some of them which have underperformed. We think that this is just a cyclical phase where the performance has come. Over a period, these have always generated. If I take a 10-year return of the top 3 banks, they are in the 18 to 20% range. And I have no reason to believe that this will not be the case in the next 10 years.
Why should it change suddenly? Yes. Point taken. Thank you very much, Sridhar.
Thanks, Latha,
for a most useful conversation, I would assume, if I were an investor. Wrap up on Bazaar Chartbusters coming up.